You're now listening to the Tax Smart REI Podcast, the number one tax podcast for real estate investors. Thanks for tuning into this week's episode of the Tax Smart REI Podcast. Today, we're joined with Marty Geier, and we are going to be discussing how he went from software to business to real estate, his journey, the incredible things he's been able to do from a tax perspective, all that good stuff. This is something you're not going to want to miss. We'll be diving into all of that in just 1 minute. Hey, Tax Smart investors, I'd like to invite you to join the 2025 Tax and Legal Summit presented by Hall CPA, taking place September 12th through the 14th, 2025. This free 3-day virtual event is designed specifically for real estate investors who are building long-term tax-efficient wealth. Over the 3 days, you'll hear from leading experts in tax, legal, and real estate strategy. Sessions will cover key topics including how to navigate the current real estate market, structure your entities for legal protection, understand the impact of the 2025 tax bill, avoid common tax scams, and preserve generational wealth. You'll also learn what's changed with IRS audits this year, how to avoid the biggest legal mistakes real estate investors make, and how to efficiently find and fund your next deal. General admission is completely free, but for those who want to take it a step further, VIP tickets are available for just $77. As a VIP, you'll gain access to exclusive bonus sessions, including a private legal Q&A with a real estate attorney, a one-on-one laser session with our tax strategist, and much more. You'll also enjoy priority access and extended replays of select sessions. This is a must-attend event for the year if you're a real estate investor who looks to minimize taxes, protect your assets, and build real lasting wealth. Reserve your ticket for free or grab your VIP pass for just $77 to access the full experience by visiting www.taxandlegalsummit.com/registration. Again, grab your free tickets or reserve your VIP tickets by visiting www.taxandlegalsummit.com/registration today. We'll see you there, but for now, right back into today's episode. All right, and we're back. So Marty, thank you so much for taking time to join us today. Before we kind of get into the business, the real estate, all that good stuff, could you just give us an overview of your background, kind of how you got to maybe where you are today?
Yeah, I'm a little bit older at this point, so I've been through quite a bit. I did the kind of a smart kid thing from the beginning. I went to the best colleges for computer science, got a bachelor's in computer science and mathematics, got a master's degree, was in the PhD program for computer science and artificial intelligence, actually, and educational technology, like really interesting technology stuff. So I'm a technologist by background. I've been working on computers since I was 8 years old. I like doing little programs. I'm kind of, the brilliant tech guy from way back at this point. But I kind of got, I originally was going to do the whole AI track thing, but it's now a big hotbed again. But for a while, it was definitely thrown out. It was kind of researchy, and I didn't really attach that well to the research world. So I went out with a master's degree and then started like, okay, I'm going to do the business route. I'm going to go make money and do wonderful things for the world, hopefully. So that's the kind of route I went. And I started up all of my business, all non-traditional, right? So weird stuff, at least back then. So I started up actually a gold selling business on an online game, EverQuest, if anybody's familiar, World of Warcraft, because this was early 2000s. And ran it for a few years pretty successfully, sort of. And then I kind of just could not compete. I did not have the money and resources to compete with the global scale of that thing. It was a weird business, right? But it was a lot of fun and experience. And I went back to software for a while. And I've always tried to start up my own little businesses and fell into things. Finally, say about 7-8 years ago at this point, I started trading other businesses and finally got one took and started making me a lot of money. So then I went from like a normal person average salary for tech field to suddenly making just a boatload of money of excess of $1 million. And then I had other problems, right? What on earth do I do with this? So that's what kind of took me into connecting with you guys initially. I initially had a different account, as many people did had a different account. And, they were absolutely brilliant. They're good accountants. But I started asking questions about, well, how do I, tax deduct this? Like, how do I not get rid of, but reduce all this income in some kind of tax efficient, but of course, legal manner? And they just didn't have the answers, right? So I searched around and around, interviewed a bunch of accountants, and really, this part I think interesting to your audience, right? And I'm sure you heard this before, is almost everyone I talked to were brilliant accountants, been in business for 50 years, knew what they were doing very clearly, good guys. But almost every one of them was like, whoa, that's too risky. What you're trying to do is too risky, because I would originally read the articles about rentals and short-term rentals and like, well, can I do that? I want to do that. Like, that seems like the way to go. and it was just constantly turned away until I found you guys. And it was initially actually rejected. It's a funny story. You guys were like, nah. And it's because I didn't have any real estate. So I'm a big planner. So initially I went to contacting you guys before I had any real estate whatsoever. So I think initially it came in and it's like, well, who's this guy? He doesn't have any real estate. So what are we going to do with him? But I very quickly ramped up. And now at this point, I have 7 properties, like 6 that are rentals, right? And that's 2 years. This is 2 years time since I've been with you guys.
Yeah. Awesome. It's quite the transition there.
Yeah. Walk us through, Marty, just a little bit of the portfolio. You said 7, just kind of walk us through like kind of timeline and what you've got a little bit more specifically, just for the audience to kind of get an idea of what you've got.
Yeah. Absolutely. Yeah. I'm happy to elaborate. So 2023, we were at, I guess, and even late 2022, I was really searching for some kind of tax deductions or something to do. And initially, I'll speak about the one business quickly, then I'll go into real estate. So in 2022, again, I was like, I don't have anything. I hadn't found you guys yet. So instead of because I didn't know how to do the real estate piece. So I opened up a new business instead and used that for the tax deductions, which is a method that I know I've talked to Ryan a lot about. Ryan was my advisor for over a year, right? So he helped me personally with all these things. And then in 2023, once I found Hall CPA, I started really planning the real estate things, and I purchased my first 2 properties, investment properties, in I think it's end of July, beginning of August, 2023. And I didn't go small. I got big right away. I mean, one of them was like $300,000, but the other one was $1 million beach property. And then I ended up buying 2 more by the end, right? 2 more by the end of that year. So it started with 4 properties at the end of 2023, although one was a residence for me in New Jersey here, where I'm at for work purposes, mostly, and living purposes. So it's 3 investment properties total, 4 properties. And then 2024, upped it again and went for an even bigger beach property, because why not, in Lewis, Delaware. These are all Delaware properties except the one. I did buy the one then in 2024 in Florida, in the theme park areas in Kissimmee there, because I visit there and I like that area. So it seemed like a natural place to invest in. Turns out it's not anymore. Not right now anyway. Like, don't go there right now, or unless you want a really risky investment, but potentially good payout. So then I did, I guess then the 3 more, right, in 2024, the Florida property and the one beach house, and then a commercial property. Because all the rest of it were residentials that I turned into short-term rentals, and then a commercial property at the very end of the year last year, where I'm trying to figure out exactly how to do that and grow more businesses out of it. So I'm trying to take a sort of real estate approach, but also a business approach. And then I'm a big fan of passive investments, because this is a lot of work, guys. Like, if that's not apparently obvious from listening to all these podcasts, it's a lot of work. So, I have time to do it. So I'm a big fan, but don't kid yourself. Like, you stick stuff in a stock and it's so much easier. I mean, you're not going to get those guaranteed returns, but so much easier.
So multiple properties. And for those of you listening, because Marty is, primarily a business owner with a significant profit at the 37% bracket for himself, the main thing with being a business owner and doing that substantially pretty much full time is we had to evaluate other options if we're getting into real estate, that it couldn't be real estate professional status. We couldn't hit the 50% of our time requirement. So as we were working together, it was like, yep, short-term rentals. And you, I think, being a math person, were just like, yep, the bigger property I get, the more tax savings I get. So I was like, great. It may maybe seem small at the $300,000 purchase first, but it was like, hey, because of the profits that you're getting from your business, you could allocate a lot of that to a down payment or buying bigger properties. And then that led to you getting significant tax savings. And one of the things that was very interesting with you, we'll get into your business here in a second and how that kind of played into your tax savings. But one thing that was really interesting is you kind of having to think through all of the grouping elections. Okay, do I just get the material participation with one versus the several? And are we grouping all of those appropriately? We've got all of them that you're owning 100% yourself. So the dash for election was pretty simple for you, but just kind of thinking through, okay, I've got time here and then time here, a little bit less time here. I've got this one in Florida. Hey, what if I don't have a significant amount of time there? And really just thinking through with your full-time business, how are you going to actually do this realistically to achieve the material participation you were looking for? And especially now over 2 years. So yeah, that was significant tax savings. I think 2024 was even a better success than 2023. But yeah, certainly as you kind of get into this, thank you for just telling people, hey, this might sound simple on the front end. And it's easy for us as, a CPA advisor to kind of say, hey, here's like kind of the requirements and here's the things to look out for, reviewing documentation and so forth. But at the end of the day, it is going to be time and it is going to be an investment of your capital. And it is going to be something that you need to really put time into overall. So I would love to get into your business here in just a second, but yeah, just wanted to kind of lay out some more of that for listeners, that if you are a full-time business owner or full-time kind of W-2 employee, you've probably heard us say 1,000 times, short-term rental is likely going to be the case unless you've got a spouse who is not working full-time and is really willing to put in the time into, real estate or something like that. But yeah, so if you don't mind, Marty, telling us, so you've got your kind of mostly full-time business, you've got at this point now 7 properties, and then tell us a little bit more about kind of your businesses and how you've kind of done that.
Yeah. So briefly on one of the points you said, I think it's important, is the time hours, because this is a very difficult way to try to organize for me. So fortunately, I don't work 60 hours on my primary business. So I was able to take it to more like 20, 25 hours a week. So then it had something to play with, because then when I learned about the 500-hour requirement, that's what I stick to for short-term rentals. It's like, okay, so I'm going to grow this business of real estate. So I need that 500 hours, because you guys have been through this numerous times, but just to reiterate, your 100 hours and more than anybody else can be dangerous because of cleaning. So I'm not a hands-on guy, especially with this many things going on, as we'll talk about. So I'm not getting into that property myself and cleaning or doing anything like that. So I'm hiring cleaners. They have to be consistent. They're going to generally spend more hours than me in a particular property, but different cleaners for different properties. But either way, you just avoid the whole issue, make it simple by going 500 hours. And 500 hours is 15-ish hours a week. So, this fits. If you're talking about trying to create a time scale, I mean, I certainly do work 60 to 80 hours a week, which is not recommended, but it's possible, right? So 25 hours of primary business, 15 hours a week in short-term rentals. And then, like Ryan was just asking, I'll elaborate on doing active business, you can put about 10 into that, depending on where you're starting it during the year. And you can still make this work. You can still make a 50, 60-ish hour career here and still do this. Maybe not perfectly recommended because it does take a lot of balance. But to that point, what I started doing in 2022 initially before the real estate, and I've continued in 23 and 24, every year is I try to start one business in addition to the real estate, in addition to my primary business generating the income. So I feel like this works well because A, it's diversification. So you're not just in one thing. And then again, I'm also maxing out, a pension plan as well as self-employed 401k. And that's, by the way, the first thing I'd always recommend to anybody is step one, because it's easiest, is get that money in retirement first. So if you're talking about a little bit of extra money and you're not trying to offset crazy amounts of money, get into retirement savings first. You can do that very easy yourself with a SEP IRA. And I did that for years, just a SEP IRA. But you are limited on a SEP IRA, and you can't create a pension plan with a SEP IRA. And correct me if I get any of this wrong, but this is from my research before. So then I had to create a self-employed 401k, which then adds complexity, and then you can add a pension plan to that. So then you can start socking away as much as, it depends on your age, because there are calculations based on your age, et cetera. But we'll say 100,000 a year pretty easily in all those plans. And then that's nice and passive, nice and easy, no hours there, just sock it away, put it in your favorite investments, and you're done. But, as many of us might need more than that, you go on to the next level. So then you have to go on to business or real estate. So I'd recommend the business route second, and then, all three of them if you have to. So the business route is start up an active business, and you want to be active in it because, again, you're measuring, like Brian was talking about, you're trying to offset active income from active income, so you can't mix the active passive. I know you guys have talked about that numerous times. So you need to create an active business, but this is actually, in my opinion, not too bad to do the first year you're doing it. So my goal has always been create an active business, then transition to passive after the first year. And that way you don't have to put these crazy hours in it, and you can just repeat this process. So the idea was in 2022, I started a business this was a partnership. I've since tried to stick with sole proprietors because they're just easy in terms of accounting, obviously, where you have to file all those forms, in terms of just filings everywhere, the legal stuff, and all those things just make it so much easier to sole proprietor. But, that's just personal opinion. So the first year I did do a partnership with my best friend, Selena Francis, in Delaware. It's a Bloom Beauty Bar, because she's been an esthetician forever. So, Warren Buffett rule, don't invest in anything you don't know anything about. That's also just, again, my good recommendations I try to stick to. But I have violated that several times because I have good friends, business partners that are brilliant at it. So it's stuff that they know at least, right? So I have the money, I have the accounting knowledge and the business knowledge to push something forward. They have the knowledge and the drive and the ambition to run the business. And so that's kind of the split we use. But the first year, to the point, is you create this active, so you need to be active in it. But where there I've used the 100-hour and more than anybody else rule there, because trying to get to 500 there is tough stuff. And especially if you're doing real estate and all these things, that doesn't math well. So use the 100 and more than anybody else rule for those. And that works really well because then you're talking about like 10 hours a week. So you can squeeze it in, and then you don't have to worry about substantially all, because that's a lot, right? It's a lot especially if you don't have a business that you know everything about. If you do, great. Yeah, plunge all into it. But again, if you're running something else that's generating primary income and you're doing real estate and you're doing it, it's too much, right? So the 100 more than anybody else, because it's going to take you 100 hours to set up a new business. It always takes me 100 hours. I mean, all of mine have been in Delaware, but regulatorily wise, you have to file the business license. You have to apply to the state stuff. You have to get all the licensing. You have to get the specific licensing for the type of business. You have to buy machines. You have to rent space. You have to talk to people. You have to create leases. You have to create contracts, set up payroll, et cetera, et cetera. It's going to be time consuming. So 100 hours is not hard to get to. And then the other method I've used is to do this at the end of the year. So try to start at the end of the year. And that way, your 100 hours, you're not going to have anybody that's going to exceed you either. If you start in January, this is going to be harder, right? Because if you're trying to transition off to essentially a general manager to run everything, which is what I've been doing, then somehow you have to put in more hours than your general manager, which is tough stuff. But if you're at the end of the year, now it's not too bad. You can do all the setup yourself. General manager takes over and you can make this work, and it all works very nice hour-wise. So I started up as esthetician business. Bloom Beauty Bar does beauty treatments, lashes, nails. We do injections, facials. We initially did a few other things as well. So we start focusing on more profitable, like narrow down into niche markets, into what you do best, right? And again, fortunate to have a best friend that's brilliant at that. She's an esthetician forever. So then I just hand it off to her. She takes over. She does all the great work, and it's been running a few years now. And, the nice part about it is you take a business loss up front. So there was equipment. So we start buying equipment, and that's an immediate deduction, either bonus depreciation or section 1079, right? And I think it ended up being 1079 for me in all cases. But then you can kind of mimic the same thing as real estate, which is nice. You get these business deductions out, and it's active for you because you're now active in the business. So the first year you can write off, you buy all the stuff the first year, right? And then transition it to passive second year. So buy all your equipment, get the deductions, then move on. And then I would repeat the same thing. So in 2022, I started the one business. In 2023, I started, which one? 2023 was Medispa. So it basically added on, but it was a separate business to do laser treatments in the esthetician field. So you're doing skin treatments for all kinds of things. But the nice thing about laser stuff, which I didn't even really think it all through it until it happened that way, is big costs, right? Lasers are expensive. Right. And again, 1079 deduction. So nice. So I spent $350,000 in lasers in 2024. 10,000 in lasers in last year, that was a lot, right? But I get to just write it all off the income brilliantly. And then, of course, in that field, you would expect a return from that, maybe not right away. It still does take a couple of years to see profits from it. Same way as real estate. You dump in a lot of money in initially for a down payment, especially at today's mortgage rates. I would not expect to see, maybe you're more brilliant than I am, but I did not see in the first year yet any of these businesses returning, enough to cover 8% mortgage rates plus all expenses, plus time down because you don't have the customer base yet. It kind of parallels that very well, which is interesting, right?
So if I could just jump in here right now, basically what I'm seeing is and correct me if I'm wrong here, but this is a big learning lesson for everybody out there who does want to get involved in business. So kind of like what you do is you come in with maybe the money, the business plan, things like that, and then you have an operator actually operate the businesses that you're involved in.
Right.
It's a major key for people out there who want to run multiple businesses. That's how you get it done, because you can't be operating all of these businesses yourself.
Yeah,
you can only put so much time you have in the day. Yeah, but you can come in, put things together, and then put an operator in it and let it run from there.
Right. Okay. Exactly. That's kind of the goal.
With 2024 officially in the rearview mirror, now's the perfect time to start planning for how you're going to maximize your tax savings in 2025. With major tax changes looming under the new administration and IRS audits on the rise, navigating the tax code alone is now riskier than ever. Whether you're leveraging the short-term rental loophole, claiming the real estate professional status, utilizing passive losses, 1031 exchanges, or anything in between, our expert team of tax advisors at Hall CPA has your back. We'll help you uncover hidden opportunities and avoid costly mistakes that could put you at risk during an audit. With potentially tens of thousands of dollars of tax savings on the line, why wait? Visit www.therealestatecpa.com/podcast to request your free 30-minute discovery call today. Again, that's www.therealestatecpa.com/podcast for a free consultation. Let's help you ensure you keep more of what you earn in 2025. That's all for now, and we'll dive right back into today's episode.
Yeah, super similar to what we have talked about in the past, Tom, where it's kind of like what Marty was just saying, but just to reiterate in like a nice little summarized version. Basically, what you can do with our kind of short-term rentals, right, is we get the non-passive material participation in the first year, get the cost seg, get the losses. And then if someone wanted to in the second year, right, January sometime, we hand it off to a property manager. And now it can become passive. Right. And maybe depending on losses or income, we might say, who cares, right? As far as kind of tax savings and efficiency there, it's kind of the same idea that we did here with the business. Marty's going to set it up, get it started, have some customers coming in. And then kind of the second year when he needs to transition into something else or buying more real estate, hey, I already have someone, a friend, who can take that over and manage the business from there. Kind of the same idea, just bringing in a manager in the second year and then it becomes passive.
It's like, it's incubating. I think that's the word for it, right?
Right.
Yeah. It does. The parallels are just kind of amazing to me. And that was all accidental. I didn't really, until I started to do it. And I realized, oh, okay, this is kind of the same thing. Mostly I knew the business end a little more, but realizing the real estate and the short-term rental end was more parallel. Now I accidentally have been doing a good job doing short-term rentals. So now, I'm buying these massive big assets to go back to the rentals and, oh crap, I need to figure out how to do this in kind of an efficient way. Cause you can't always just pass it off to a property manager, and you guys have had a lot of people on, and I told Ryan before, I make fun a little bit, not to pick on anybody in particular, because you're just lucky, great. But I came in and started buying real estate in 2023, which is a different market than buying real estate in 2020, 2019. In 2019, you come in with your 2% mortgage rate, no problem. You can pretty much cash flow anything you want at that point. Like, you're golden, which is nice, right? But it is a different world now, which sucks for us newer real estate investors that I kind of missed that boat. But now I'm in this problem of, okay, well, I got to figure it out because it's still a really good tax deduction initially, but then you have to run it, right? So you can easily just, okay, property manager, go. But they will take 15, 20%. And they'll do a good job generally, but 15, 20% hurts when, again, you're talking about so my mortgage rates go between, I bought one down to 6.7 something, but generally they're 7.5, 7.2 to 8. One of them is at 8.25. It's just ridiculous numbers. And I had to be clear, I had to struggle to get that. And it's not that, I have the money, I have the financial resources, and I have decent credit scores, but it doesn't matter. As soon as you say the word investment, boom, interest rate goes up by about a point. Has been my experience. So when interest rates last year, during these times I'm talking about, where it's 7.25, that meant 8.25. And it's a struggle even finding the right mortgage company to get it just shave off a little bit, because it is important. You can just shave off a quarter point. That's a whole nother topic, how to find good interest rates. But I've always done them in my personal name and then transitioned to LLC, which is a pain in the butt, but that's how you get a little bit of a discount on it, at least in this day and age, right? The current state. Who knows if the Fed Reserve is going to act more and we're going to get that down. Hope so, of course, just like everybody else, but can't depend on it, especially right now. So anyway, to go back to operating them. So I started with one or two, not a big deal. My mom is helping me with all these. She's my brilliant property manager who accidentally happens to be really good at that, which I've just been lucky in some ways like that. And I've had my girlfriend helping the cleaning. I've had friends help with cleaning. In 2025 now, this is no longer really sustainable. Just ask all my friends and my family to help. So I was paying them, to be clear. I'm not paying anybody. I'm paying them all to help. But finding good people is hard. So now we've started to go to hiring. So we've hired several cleaners. And I unfortunately set this up. I'm trying to diversify too. So I was trying to have 2 beach properties, Southern Delaware. And I know you guys are not going to be generally familiar with Delaware, so I'll explain it. But Southern Delaware beach areas, and then 2 properties, Northern Delaware, Wilmington, Delaware, the capital up top. And that is about 2 hours between them drive. So, and then I'm often up in New Jersey for my primary business. So, I do struggle to be able to get, they all are drivable. The longest one is 3 hours, 2 hours, 3 hours, and then a couple of them in Wilmington are like 45 minutes. So I can get there. I can do things. And that's how I operated in 24, more in 23, at the end of 23 when I started, is go get the hours myself, right? When I had only 1 or 2 properties, go on site, get things done, because I am very careful. We'll echo, Ryan Thomas's good points about keep the records, because I'm certainly thoughtful, we'll just say, of IRS audits, given the number of things I have going on. So I'm keeping the records because, I want to make sure that I can defend it. And it is legit. It's all legit. So it's all written down and all defendable, but you do need to go get the hours. So a lot of go get the hours is I'd travel to Wilmington. I would do things on the property. I'm not a great handyman. I'm a terrible cleaner, but, got a toolkit. I can do a few things, even if just check over the properties. I always found, especially at first, no matter what, I'd go to one of my properties and there would always be 5 hours of things to do. There just is. When you haven't been there in a while, there's always something to fix, something to tighten, something to review, even if it's just, oh crap, I need to buy another one of these. Or how about if I bought, because you guys had, I forget who it was, I apologize, that just on about short-term rentals not too long ago. It's all about amenities. And that's absolutely true. So, well, what if I added a ping pong table here, or added an arcade machine here for the kids, especially at the beach houses. The beach houses are definitely amenities. So, each beach houses, I got the ping pong table, I got arcade games, got card games, we've got one, there's kayaks at it. So there's always something you can add or change or fix, which helps you get the hours. And then when you have enough properties, it's really not hard anymore. At this point, I transitioned to doing mostly back end. I use HostAway as host management. And I spend an enormous amount of time with the finances, the back end, talk to customer interaction, creating the door codes, customer service back and forth. There's always something going on. There's a refund here, a change there, or what happened to this, and then just managing your other staff, right? Property managers, cleaners, et cetera, and getting everybody paid and getting everybody happy. And those kind of things take hours.
Yeah. And one key I just want to kind of help people understand with Marty's situation that could be a takeaway for some of you. And then I want to say one other thing too. So number one is that you're probably hearing themes with Marty's situation. One with, say, the businesses that you've started with your friend, which is you've got equipment and you've got an initial investment of something that is an asset that we can then either through bonus depreciation or Section 179 take that depreciation to drive additional losses immediately over something that normally if we, didn't use them for whatever reason, we would just take that cost of the asset slowly over time. So that's a key point, whether that's the businesses or the real estate, right? The real estate, we're using things like, with the short-term rental strategy, cost segregation studies to accelerate that depreciation for Marty. So just one kind of common theme for those of you listening, not just the, hey, non-passive first year and then potentially passive the second year. But the other thing I just want to help people understand with Marty's situation, which could be unique for some of our listeners, which are kind of all over the place, but all of you are interested in real estate investing, is that Marty is really first and foremost built a good, profitable business, right? That was the first thing that you have, Marty, that kind of differentiated you having that capital to even one, have the issue of like, holy crap, I pay too much in tax. And so now I have an issue. And so now I need a tax strategist to help me think through, how do I offset this? And so as we were strategizing and as you were already planning, you then basically took that excess capital, put that into other investments, which was the business, which then was capital, again, asset heavy, which generated losses. And you did the same thing with the real estate. So point is, first, if you're just getting started and you're like, hey, I'm a W-2 employee, I make, 100 grand. Hey, we've got to get some capital here first. And maybe you want to first focus on how do I maximize my potential within my current job? Or maybe you're thinking about, something on the side. You've got to get that capital first in order to then say, hey, now I can do kind of what Marty's doing, which is invest in these businesses and invest in real estate. We can't just say, hey, I've got 2,000 and I'm going to go put it in some stocks. We got to have some more substantial income and capital in order to be doing these things. But just want to kind of show a couple things there as I was taking away. There is kind of a theme there that I think other people can kind of replicate too.
Yeah. And I spent plenty of my career not having all that crazy money coming
Right.
in. So like I said, no shame on it for sure. It's not easy to make crazy money. So we're talking to a very small percentage audience, which is your audience. It's good. But the other way is just, sock some money away in retirement in the meantime until because you should be doing that at least. Yeah? And you don't need to come up with $100,000 down payment to sock a little money away in retirement.
Right.
Hey, real quick, if you've been a long-time listener to the show, then you know we give everything away for free, from how to use the real estate professional status and the short-term rental loophole to save tens of thousands of dollars on taxes, to upcoming tax changes, including the potential return of 100% bonus depreciation. We don't hold anything back. And the only way we're able to help more real estate investors is if you rate, review, and share the show. It just takes 15 seconds to leave a quick rating, review, or share with a friend who may find this information useful on their real estate journey. That's all for now. We'll dive right back into today's episode.
As we've kind of looked back of kind of where you've been and kind of what you've been doing, what for you is kind of looking forward? Where do you see yourself headed with businesses and or real estate? Any major changes or just kind of staying on the same path? Tell our audience a little bit about that.
Yeah, that's such a tough question because, I hate trying to predict the future. It's so difficult, right? I kind of feel pulled both directions at the moment. I'm eyeing the exit plan because, I have money, so why not retire? But at the same time, I'm restless. So, and now, like I said, I've started, this is very recent, Ryan, like just in the last couple of months, started looking at the numbers because beach properties now are making good money and going, oh, actually, I'm not sure how to frame it if it's not really cash on cash returns. I'm so bad with the particular metrics, but just in terms of property price, making like 10 to 12% on like the cost of the home, which I think is roughly cash on cash, but on that percentage, it might not translate. But anyway, so now, like at least a couple of these properties, the Florida one's struggling, to be clear, so it's not just always easy peasy, but able to actually make back the 8% mortgage rate plus the cleaning, plus the maintenance, plus the blah, 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 and come out at least break even or profitable. And that's always been my goal, is just break even. I'm not ambitious. I don't even, because you get the appreciation for the properties that you guys have talked about a million times. And that's important too. It's fine to break even on expenses, especially at current interest rates, I was going to say, especially right now. If you have an 8% mortgage rate and then you have maintenance costs, you have all these other costs, breaking even is great because you're just holding out for some appreciation going forward. But I'm always eyeballing the exit plan, which I think for me is to sell off at some point when it becomes viable, because it's still early to do that, to make things more passive so they don't require all this like extra work. But at the same time, I'm also like, well, I have to eyeball where my income is in any given month or year for my businesses and go, well, yeah, probably. And, I think, from experience, and I'm thinking from experience too, that's going to require more properties. So I haven't pulled the trigger yet right now in July, but I'm eyeballing like, okay, what's next to buy this year? How do I buy a big factory somewhere and write it off, right? Because that was my takeaway from the big, beautiful bill so far, is the need a factory. But, barring that, anyway, we have 100% bonus depreciation. So go back to buying a house. Because if you're mathing it up here, I was at 80% and 60%. I have not yet been able to take advantage of 100%. And that's fine, because a lot of the stuff that, like I said, you could buy that ping pong table, you buy that arcade machine, that's immediately expensable anyway. And of course, you get the 80%, it's still quite a bit. So my deductions were still very heavy. It's not like I had to take only some of them and there'll be a lot more this year, next year. Most of them were still up front. And all CPAs still always finds a good way to maximize those deductions out, whether it's 1079, bonus depreciation, or other little tools to get that first year depreciation as high as possible. And of course, they're brilliant at it, so always recommend. But yeah, I might need to add a couple properties. And the brilliant part about the adding properties at this point is I got my 500 hours. That's easy now. So if I add a property, I don't even have to do anything. So that's what I think you want to get to, is that point, at least on the short-term rental side. And I could just flip any of them to long-term at any point too. But like I said, I accidentally have become too good at running them. So, look at the numbers and going, well, if I switch it to long-term, it's going to be 70% maybe of what I'm getting now. So why, So keep the short-term rentals. And then if you add one or two, there's no time involved. I would just, at this point, my mother's obviously got a lot to do, and my family members that help me either create some kind of crazy infrastructure, which you've had other guests on before to talk about that. So they're way better at it than me. I'm still learning, but create an infrastructure to be able to handle all these rentals. Or what I'm leaning towards is just buy a new one, transition to management team, and let them run it. And then it's fully like it's an expandable architecture, pretty much. I think I might be topped out on the businesses at this point, creating 3, one this year, 1 year, 1 year 4, and might just stick with the real estate because it does still require a little bit of your time, even if you have a manager running it. So I think my total businesses of everything, including counting each house as its own thing, is up to 10 now. And I feel like at this point, it's getting a little business heavy. Like, I don't know that I can handle 11, 12, So if I'm buying another property to offset income at this point, at least I feel like I can do that in a way that's sustainable by buy new property, do the tax study, get the bonus depreciation for the tax benefit, and then hand it off to a property manager, let them run it. And then I can do that. That's easy then. I mean, it's still not easy to buy a property, to be clear. I'm still like, I feel like I'm always talking to a mortgage company for like 50 hours. Like, it's just ridiculous. At one point, that was a question to Ryan. I'm like, Ryan, you're telling me like we can count this and this, but like I'm sitting on the phone with a mortgage company for 50 hours, to get this one mortgage done, So if I'm buying 3 mortgages, that's 150 hours. Can I count that? And I know the answer is complicated, but it takes a lot of time to buy a new property. But besides that, once you have it done and you still have to, pay the mortgage and set up all those things, auto bill pay, right, is really good for those things too. You can transition it off to another property manager and expand. So I kind of have 2 different paths. The answer to the question is, one is, am I eyeballing to get out and retire when I'm ready? 2, but in the meantime, I like to stay busy and I'm having fun organizing this crazy mess of things that I'm trying to still turn successful, because it's only been 2 years. Everything is not successful just yet, but it's kind of a challenge. It's a goal, right? It's super competitive. So like, can I get these things all making money? That was the original point, not just to be tossing money away. So get them all profitable and then either sell them off, let them run themselves with business managers and other people who can sustain them. And the real estate the same way, hire out an architecture to do it or a property manager to do it for you, and hopefully refinance mortgages down when they can come down to keep expenses low. And then, like we talked about before, I haven't gotten there yet, but on appreciation, pull out more money, buy more properties as needed to continue the tax benefits until ready to get out and sit on a beach somewhere. I'm not really a beach guy, but sit in Disney World somewhere.
Quick question on the businesses, right? Because this is super intriguing. It's I always find it intriguing when somebody's running multiple businesses. Do you like a scorecard, or how do you keep a pulse on how effective the businesses are running? Right, each unit.
I'm a big fan of the records. Sorry to say, I always hated QuickBooks. I know you guys push it all the time. I cannot with QuickBooks. I don't know what it is about that software, but I do use Quicken, and I've mastered Quicken pretty well. So I have it all in Quicken, and I keep close tabs. I want to see what my loss is, so I need to, so I can give it to you guys for tax season, as well as just keep score, like you said. So I know, like, I can look now in July, and I've got it all coming in Quicken, syncing up, same way you do in QuickBooks. And I have to edit things up because it is a mess with a lot of it. It does take some time to edit it all up so it's going in the right categories and stuff like that. But then once I have that, I can see how much Bloom Beauty Bar is making profit and or loss in first years, and Bloom Medispa is the laser business. And then we just started with another partner of mine, another good friend of mine, yoga studio this year. That one's a little more low key, not buying big lasers, but it actually operated the same way. It's very interesting because we're making an aerial yoga studio. So aerial equipment requires aerial structures. This one I know a little more about because I am a yogi. Aesthetics I didn't know as much about, but we had to make aerial structures. So we had to hire somebody to come in and build these big, massive structures, $30,000, right? So this year will be a loss, but again, active for the business, take 100 hours more than anybody else and get that right off. And then 2026, it'll be run by my business manager, and she's a brilliant yogi as well as very brilliant at business. And, I have no doubt we'll turn it profitably instantly next year, but I'll be watching, I make sure those numbers coming into Quicken and see what, income versus expenses are. I'm always watching those things. Yeah. And that's important. I highly recommend keep the records, even if you hate QuickBooks or hate Quicken or whatever. I know some of my friends on a piece of paper, but something to keep. Because you want to know. You don't want to mess around and have businesses that are creating crazy losses. Because there's a time to get out, I guess, to that point for anybody else. And I'm hoping I don't have to ever exercise that. But just like with a bad stock investment, you should create some upside if you're shorting stuff. I mean, I don't do that at all. I'm in long-term stocks. But if you are playing markets and stuff, create the top point you're going to get out and create the low point you're going to get out and stick to it. Don't screw around and go, well, maybe it'll get a little higher, or maybe it'll recover, and then it just doesn't. So same thing with businesses. So you need to keep track because maybe you need to sell it off, maybe you need to fold it up, because if it's costing you crazy amounts of money every year and you don't see a plan to turn it around, just like with a stock, or I suppose a real estate investment too. I'm eyeballing that with the Florida property, for example. The Florida property is tough right now. because Florida's just a tough market. I'm not going to take any action on it right now because it's only been, a year for that one. But, anybody that has Florida property is certainly worried at this point. Insurance rates are going up and mortgages are not coming down, and the competition there is fierce right now for selling houses and rentals. So yeah, you may become a time where get out, take a loss on that,
But it sounds like the scorecard, to answer Tom's question, is you're just primarily looking at financial statements. Like, how are each of these properties doing and the businesses? That's great. And one thing I just want to also, as you said just a few minutes ago, I don't want to bypass it because it is a very interesting thing that you're doing, which is the whole 500 hours. Hey, I've already met that. That's really great because just like you said, if you added another short-term rental and you got 1 hour, 5 hours of material participation, then you can now group that in because you meet the -4 grouping election. That's great. Like, you've already met it. And so almost by default, we've got to make sure we get the election correct, and we want to do a cost seg, and we make sure it's an average stay less than 7, all the normal things. But you've made it very easy on yourself for the rest of this year. And now with 100% bonus depreciation back, you have this kind of very easy road, theoretically easy, much easier road than you've experienced in 23 and 24 now, just historically, much easier road to accomplish your tax saving goals, to get the savings that you've kind of been really working a lot for. And that's the cool thing, as any of you might be looking into this of hey, I'm buying my first one. Great. One day in 2, 3, 4, 5 years, maybe you're not growing as quickly as Marty is because of the capital he has to deploy and really serious about tax savings. You might be in a place that in a couple of years, you have 5 properties and you are able to really easily get to the 500 hours. And then you're at a place where, wow, these are all cash flowing and I've got all these tax savings that just each year you're buying a new one. And then every year you're getting the 500 hours after just a few months, halfway through the year, 3/4 through the year, and you're getting these continual massive tax savings. So there is a scaling option here, including the tax savings that can come from this. So yeah, massive things that you're doing there. And it's very exciting for those of you who are like, yeah, I want to do this. I'm excited about this. This could be an option for you as well.
Yeah. I don't know why I never took that away, because it's kind of an obvious takeaway, but it's never really explicitly stated. So I'm glad you're reiterating and stating it, because when I was working with you, I feel like it took a whole year before I realized just that simple point. Wait a minute. I don't have to put in all this new hours every time there's rental, because it just felt that way. But then you're like, no, you get to 500, you group them and you're good. And I'm like, oh yeah, that makes sense. But I never stopped to think about it, because it does create a sustainable architecture like that.
Yep. And very similar too, for those of you who might be in multifamily or long-term rentals, if you've got someone who, say you've got maybe a full-time physician and maybe your spouse is not working, if they can claim real estate professional status, and then even if you're going to go buy another multifamily, you put in very little time, hire a property manager right away, or even syndications, right? You're an LP, right? We can still group in that long-term rental for those of you who are more in the reps, long-term rental route. You can do that. It's a very, very, very similar idea, just with reps, long-term rentals compared to kind of what Marty's doing with short-terms with the short-term rental strategy. So very, very great opportunities as far as a scaling with tax savings included. Very interesting strategies there to combine.
I'm single at the moment. I have a girlfriend, but I'm not married. So I was like, for a while, I'm like, well, I need to find somebody who's in real estate, marry a mortgage broker or something like that, because you instantly qualify for all that. Yeah. It's not most people's tax situation, but I imagine it applies to somebody that's single. Find yourself a real estate professional, and it's a lot easier. we joked. Some people marry for love, some people marry for money, some people really marry for real estate, I guess.
And taxing.
This has been an amazing conversation. I know I've kind of played the guy in the background here, but it's always amazing to see people building multiple businesses, acquiring real estate, kind of building an empire. And kind of like what Ryan said, when you're able to do it all in a very tax efficient way, very strategic way, it's the cherry on top, and it really makes everything kind of come together. So I don't have any other questions at this point, just an inspiring story for sure.
Yeah. Thank you.
Yeah, Marty, if you, just as we do wrap up, if you have any kind of final words for listeners, any kind of, here's some good piece of advice if you're just getting started, or if you're looking to kind of scale your business, anything that you just want to say as a main takeaway for our listeners.
Yeah. I'm not a real estate guy. I was never been a real estate guy. In fact, I always kind of disliked real estate as investment just because of the amount of time. I feel like I do want that as a little bit of a takeaway. I feel like people minimize, especially people on the podcast, just kind of minimizing the amount of effort that they put into real estate, because real estate is a brilliant investment. So what I've learned now from going both ways, being in it and having real estate, and then being kind of against it is, and listening to you guys talk about it and listening to a million other podcasts, because now I'm all in, right? Is real estate is time consuming and hard. So there's people that just naturally fall into it. If you're a builder, if you're a flipper, you're just really good with your hands and mechanical, or I don't know, even if you're a good cleaner and you just like to go clean houses or something, you have any kind of relatable skill that would lend itself to flipping or short-term rentals or anything like that. Brilliant, but I'm not any of those guys. So it is time consuming because I have to either hire somebody else to do that or figure out how to do that. And that's a lot of time. So I do like the diversification is the point to make is, that's why I'm doing what I'm doing. I do have, I do put a lot of money in the stock market every year in my retirement savings. I do that first to get pension, 401k, and then, trying to start up these businesses to get diversification of income from there too. So real estate, I have businesses, and then just stock and pension and different levels of all that. Just diversify everything out. I think that's really important. I know I'm talking to the real estate crowd here, so we're heavily bent on real estate, but I think it is better to diversify a little bit and not be 200% in real estate, have a little bit of something else. Same way is the other way too. Like I should just be 100% stock market. I'm not touching that real estate stuff. But the brilliant thing about real estate, when you stop to think about it, is our society is built on real estate as a tax efficient method. The laws that are in place that you guys mentioned a million times. So it is favored by governmentally and tax wise and tax law. So you have to take advantage of that. I feel like you're missing something if you don't take advantage of that at a certain level. Again, if you have $50,000 and that's all you got, put it in a retirement fund. I wouldn't mess around too much. But if you have a lot of money and you're trying to figure out where to put it all, diversify is kind of the point I make. And the other interesting thing I always thought, Marty's interesting life lessons, right, is so what was the year of the law? I keep forgetting the year of the IRS passed. It was 1986 when they passed the original separation. So before that, because I used to listen, we all used to listen, I think, to our parents or grandparents or whoever talk about this stuff, baby boomer generation, Generation X, but my parents are baby boomers, and everybody was like, real estate, it's the best thing in the world, And I'm like, is it? And the reason why that comes from is because, before 1986, you do whatever you want. I mean, everything was just active. You could just write off whatever you want. It's so brilliant. Like, it's such a brilliant time. So you got to do your research and measure things too. It's the other life lesson, because my parents are just 200% in real estate, but it isn't for everybody in all things. It was because before 1986, you were absolutely just an idiot if you weren't in real estate, given the amount of tax savings at a certain income level, right? But things are different now, but they still are very efficient, and you still take advantage of these things for short-term rentals and reps that you can absolutely do that. And that's the right way to go. And I've spent a lot of time researching everything else, and there isn't really anything better than real estate at a certain level to do all those things, to diversify, I think.
Awesome. Marty, thank you for joining Tom and I and kind of telling us some of your story and kind of working with us, what that was like. I know we've had some great results. We didn't get through numbers, but that's okay.
I don't even have them. If you have the numbers here, but the taxable income last year was, I think I was down to 40,000 or something.
Yeah. Like that. And what did you start with?
That's crazy.
Do you remember what you had for profit?
I don't remember. It was 1.4 million, somewhere in that neighborhood. It's just crazy reduction. I was not going for that much reduction. I feel like at a certain point it's diminishing returns, right?
Yep.
But we talked about 37% tax bracket, but also I'm 8%. So Delaware tops out, New Jersey tops out at 8, and Delaware tops out 7 or 8. So it is still effectively 45%. And so as much of that, my properties and businesses are all in Delaware, so I can 45% off that Delaware number is nice, super nice.
Yeah.
Marty, I want to thank you again for joining us today, and thank you everybody for tuning in.
Thank you both. Yeah, thank you.